All right. So, what do you think about this Barry versus Commissioner case?
All right, Barry. Why did I choose Barry? There's not a ton in Barry itself, other than it's all too common a situation that we encounter in our daily lives. And what I mean is business owners, right, trying to walk that line, that tightrope between business expenses and running personal expenses through their business. And I just want to point out when it works, when it doesn't, and the requirements, right? Barry facts are even more simple than the Heidegg facts, right? You got this guy, Barry, obviously, and Barry and his kid own a construction company called Phoenix Construction. But they also love to race cars. And so they spent a good chunk of change, like 120 grand one year, getting this whole race car ready with Phoenix Construction dollars. Okay. What they didn't think to do when they went and raced their car, they raced under the name Barry Racing. They didn't race under Phoenix Construction. They didn't splash Phoenix all over the car, right? These are stupid things. These are simple mistakes. But they argued that this was a business expense because they met a lot of their clients at the races and they struck up conversations about what they did for a living, and it helped their business. Now, there's not anyone that's listening today that doesn't have a client that wants to make that argument, right? That some type of quasi-personal expenditure is really helping their business. And so how do we know? How do we determine if it is or isn't? And so let's understand the baseline here, right? What I love, and I'm telling you, buddy, part of the magic in what we do here with these 10 cases is the choreography, right? Like case one, we start with section 61, which is the groundwork of income. Now at the halfway point, case 6, we lay the groundwork for deductions.
All right. I like it.
It's a careful choreographed dance we do.
That's right. It's a whole routine. You build up. It's I like it. Yeah, good plot twister.
So section 162, right, tells us that a business can claim a deduction for its ordinary and necessary operating expenses. Now we'll save the conversation for what does it mean to be a trade or business for case number 9. But for right now, let's focus on the thrust of the Barry case, where he's claiming we get a deduction here for these race car expenses because they're ordinary and necessary expenses of my business. But what does that mean? All right. So the thing about ordinary is I think they're both pretty forgiving, right? Ordinary, we're told in a case called Deputy versus DuPont, it's not something that has to happen every day or every month or even every year. But it's something that we have to reasonably expect to happen in that type of business. And so the best way to illustrate ordinary is if you're a hardware store, you certainly don't expect to get sued. But if someone slips and falls outside one day in the snow and you get sued, it might happen once in the 60 years that you own your hardware store. Doesn't matter. That's an ordinary expense to defend that lawsuit because we expect those types of businesses to eventually have something like that potentially happen. Okay, but we have another case whose name escapes me at the moment, where like an artist, I believe it was an artist, got on a plane to travel for work, mixed some medications up, had a big outburst on the plane, caused a bunch of chaos, had to defend himself legally and claimed that those were ordinary expenses. And the court said, no. We don't reasonably expect an artist to lose their mind on a plane and create a ruckus. And so there is a distinction there. But they're very, very flexible with that rule, right? So it could be once in a business's lifetime and still be ordinary. Make sense?
It does. Okay. How about necessary?
To me, necessary is even more broad, buddy, because they just say anything that's appropriate and helpful to a business. And they'll usually let you establish that it was helpful or appropriate. We had a case called Palo Alto where a real estate conglomerate kept a plane, a private jet on standby, incurred tons of costs, but they were able to show that by having that thing on standby, they could make critical meetings across the country. They could get places that save them a ton of interest on a loan. And as long as you're able to show that it helps your business, they will allow you to decide, is it necessary to have a private jet? Okay, if it's saving you money, then we're not going to argue with you. But the classic necessary case comes from our line of work, right? The Henry case. And Henry was a guy who bought a really nice boat. I think we can go as far as to call it a yacht. And he was a tax preparer. And he flew a flag from the boat with 1040 on it. It just said 1040. And he deducted the cost of the yacht, right? Because he said, people would say to me, what's this 1040 thing mean on your, on your flag? And he would strike up a conversation and end up building some clients. But the thing is, eventually push comes to shove. And like in Palo Alto, they'll ask you to show them how it helped you. Show us the clients you got from yachting around. And he couldn't really do it. And so he lost, right? And that's, again, the cases we always use in like grad tax to teach necessary. It's like, no. Just because you slap 1040 on it does not mean that it's a business. And we know, like, the reason I'm talking about this is because we all have clients that think that that works.
I don't know where it comes from, but everybody, you're not wrong. And in fact, it almost like it's like ramped up in recent years or something with social media.
Yeah, that's what it is. Exactly.
Yeah,
you got TikTokers, right?
TikTok tax, advice. Yeah.
You know,
just put it all in the LLC. It'll be great, right? I think that's how it works, isn't it?
exactly. So you need the Lori Lynn Wilsons of the world to go out there and debunk these TikTok tax videos.
That's right. That's right. Service to everybody,
Exactly. So if we go back to Barry here, we're not off to a good start, but I do want to talk about a case because, again, we're here to see if we can talk about 50 different cases today from a couple years ago that shows how it can be done right. And that case was called Evans. And Evans was a guy, where was he? Idaho? I don't know. I think Idaho. Something. It was either Idaho or Iowa. One of the ones with the I. But I think it was Idaho. But he had 5 kids. He had a construction company. And all of his kids were super into motocross, right? But one of the kids, his kid, I think it was Ben, was the son that I'm thinking of, was a superstar, like a superstar in motocross. So dad jumped on board with his construction company and he sponsored Ben and he bought him a trailer and he splashed his name all over his bike and his uniform. But the thing is, right, Ben was such a superstar that other sponsors wanted him too. So other sponsors had him as well. And dad had 4 other kids that were into motocross. He didn't sponsor them. He sponsored the superstar Ben. And because of this relationship, right, because of sponsoring Ben, he got better interest rates. He got new clients. Like this kid was a big deal in this town. And he was able to show to the court that I can prove that I got better loan terms, I brought in new business, I got new clients because of my relationship with Ben. And the court allowed him to deduct a ton of expenses related to his own son's motocross exploits, really for 3 reasons. Again, he could prove it was necessary because it was helpful to his business. He could quantify it. We knew it was ordinary because advertising expenses are always ordinary. The second thing is, right, clearly there was value to his business of sponsoring his son because other people who weren't his dad wanted to sponsor Ben. So they had planned to benefit from it as well. And then third, makes you a bit of a harsh dad, but like he didn't sponsor the other kids. He sponsored the really good kid. And so that showed that he was really determined to benefit his business, not just help his kids out. So it can be done, but you better, 1, have a kid that's pretty darn special, and 2, have a kid that other people are sponsoring as well, because it's really going to help your case. But all joking aside, like you want to run personal expense or what looks like personal expenses through your business, you have to be able to show the IRS that they're helpful, not just say they are, show it. Now, we go back to the Barry case and come full circle. Our guy Barry had no chance, man. Like he didn't put the Phoenix Construction name on the car. He didn't, he didn't even race under that name. He couldn't point to any way, shape, or form that paying those expenses for the race car actually helped his construction business. He just couldn't. And so I just want our listeners out there to understand, if you want to be able to combat over-aggressive clients, make sure you point out these cases to them. Show them Barry, show them Evans, and say, here's the right way to do it. Can you prove to me, let alone the IRS, that these expenditures are helping your business? Because otherwise, they look like personal expenditures that are not necessary to your business. If you can't, maybe we need to lay off the TikTok for a little while. And trust me when I say these aren't deductible.
Well, yeah, no, but I think you just make a really great point there, just that the burden of proof, it sits with you as the taxpayer, and you got to back it up, and maybe squaring it up that way to say how if they come knocking, what are you able to do to show it and prove it?
Yeah, but those three cases really lay good groundwork between Henry with the flag,
Yeah.
Barry, and then Evans. You can see what works and what doesn't, and it's a high bar. It's a high bar. They're not going to let you run personal expenditures through a business just because you claim that there's some positive benefit to the company.